Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. Welcome to the first episode of the Daily MBA, where I'll start teaching you about financial accounting. And so, why did I choose financial accounting as my first episode? Basically because accounting will give you the foundations needed to understand business. As Warren Buffett said it, you have to understand accounting, and you have to understand the nuances of accounting. It is the language of business, and it's an imperfect language, but unless you are willing to put in the effort to learn accounting, that is, how to read and interpret financial statements, you really shouldn't select stocks yourself. So basically, accounting is the language of business, but what does this really mean? It means that accounting is the collection of financial statements that are reporting information about a company's performance through two factors: relevance and representational faithfulness. All of these financial statements are made following some specific guidelines and standards. The US follows their specific standards, which are the GAAP, Generally Accepted Accounting Principles, but most of the other countries in the world follow the IFRS, which means the International Financial Reporting Standards. There are 5 main financial statements. The first one is the balance sheet, the most important of all of them, and it's a snapshot of the financial position. This one doesn't reset every year. Then, second is the income statement, also known as the statement of earnings or the P&L statement. This one is not a snapshot, but it's more like a video, and it gives you the full view of expenses and earnings, and it resets every period. Third, you'll find the cash flow statement, which is also like a video, but this one will show you instead the inflow and outflow of cash, and it usually starts with cash from the previous period. Fourth, you'll see the statement of changes in equity, also known as the statement of shareholders' equity. And fifth, you have the statement of comprehensive income. From all of the statements, the 3 first ones are the most important ones: balance sheet, income statement, and cash flow statement. And in today's episode, we'll take a deeper dive into the balance sheet, which usually has this structure. The balance sheet is the anchor, and it's the most important financial statement. This one is usually explained by the other statements, which are the income statement and the cash flow statement. But as you can see, it has 2 big columns. One column is going to reflect the assets or the possessions and valuable things the company has, and the other column is going to explain how the company financed those things. And that's why it will be divided in 2 parts: the liabilities and the equity. Let's start looking a little bit further into each one of those 3 parts. So first, we have assets. How do you define an asset? We're going to do this by looking at all of the possible states in time. So first, when we're looking at the past, assets arrive from a transaction or a specific event that will lead them to, in the present, have a control or access over that thing. And also, if we look at the future, all of the assets will promise a future benefit or a future inflow, and that's why they are a company's possessions. Let's say, for example, you have a car. A car came from a past transaction, and it's giving you a present control or access over the car. And if you decide to then sell it in the future, it will become an inflow. So that is how an asset is classified. There are 2 types of assets. There are current assets, which are liquid assets that could be easily turned into cash, or there are non-current assets, which are the not liquid ones, and they can't really be easily turned into cash. Let's look at examples from each one of these parts. First, current assets are going to be, as I said, the liquid ones. So the most current asset will, by definition, be cash. Actual cash is always liquid. But you might also have other things, such as securities or short-term investments that might be easily turned into cash. Inventory is also considered to be a current asset. as inventory consists of the goods you purchased or produced and then you're going to sell them, and that will bring you a future cash. And also you have prepaid expenses, which are assets that you paid for in advance, such as rent or insurance, and they're giving you a present control or access. Another one, it's accounts receivable. And what does this mean? Accounts receivable is money that customers owe the company. So you already gave them a certain product, but you haven't received the money. And that money is going to be reported as a current cash and asset in the accounts receivable. Now let's move on to the non-current assets. These ones, as I said, are going to be illiquid. And the most famous example is a house, for example. Because this, you can own a house and it is an asset, but you can't really get the money fast out of that house. So other similar non-current assets include long-term financial investments, and similar to those, there's property, plant, and equipment, which is usually referred to in accounting as PPE. You may also encounter intangible assets, which are patents or trademarks, and maybe even franchise or goodwill. But all of this are going to be non-easily turned into cash, and that's why they're classified as non-current assets. Now that we have clear how assets work, let's move on to the next column, where we have liabilities first. Liabilities basically are obligations. And these obligations also arrived from a past transaction or event, but these ones will mean that in the future you have an outflow, not an inflow. So, liabilities, similar to assets, can also be divided in current liabilities and non-current liabilities. The current liabilities are the liabilities that are due to be paid within 1 year, and the non-current ones are the ones that are due to be repaid in more years in the future. The most common ones are current liabilities, and this include, for example, short-term borrowing, which is a short-term debt payable to banks or other creditors, but you might also see accounts payable, which is the opposite of accounts receivable. Accounts payable means you have to pay your suppliers or someone else for something that you already received. You might also see accrued liabilities. And this we'll see it a little bit later because accrued means that you're playing with time. And those are obligations for expenses that were recorded but not yet paid. And this might sound a little confusing, but it's one of the concepts that we're going to study in future episodes. Finally, as a current liability, you might also see the deferred or unearned revenue, which consists of obligations created when the company accepts payments in advance for goods or services that will deliver in the future. The non-current liabilities, as I was telling you earlier, are the ones that are due to be paid in the future or in the long term. And these ones obviously include long-term debt, which is money that was borrowed, but it's due to be repaid in more than a year from now. And it might also be other long-term liabilities like warranty or deferred compensation liabilities, or maybe even long-term tax liabilities. And so now that we have assets and liabilities, we would only be missing the third part, and this is the equity. So what is the equity? Some people even define it as the residual or the net assets. But the equity is extremely important because it's going to show the revenue and expenses, as those two will have an effect in equity. Every change in assets and liabilities will affect equity and will affect it either as a form of revenue or as an expense. Equity has two parts. The first part is the contributed equity, which basically consists of share capital. And these are capital stocks, which are the famous stocks in the stock market. Second part would be the earned part, and this consists of the retained earnings. And what are retained earnings? Basically, all the earnings a company has gathered since its birth and inception as a company until today. So every year, a company starts accumulating all of these earnings, and they all get into this same box. How do we calculate retained earnings? Well, basically, you need three things. First, you start with the retained earnings from the start of the period. And then to that, you're going to add the net income, which consists of earnings minus expenses of that entire period. At the end, you're going to also take away the distributions you're giving to shareholders, which are also known as dividends. So, briefly stated, it would be the retained earnings of the past period plus net income minus dividends. And this is going to be the formula that will give you the retained earnings, and that's why every expense or revenue will affect this part of the statement. And so, now that we know these three parts, I want to explain how important it's balancing these parts. Because as you saw, the column of assets is the same size as the columns of liabilities and equity combined. And this is going to give us the most important financial equation that we encounter in accounting. Because basically, assets will always equal liabilities plus equity. And this means that every time you affect one column, you must also affect the other column or that same column by balancing it out. That's why this statement is called the balance sheet, because it's always balancing. And that's one of the most important takeaways that you have to learn. Every transaction will affect always two financial statements. The important thing is to know when it affects them. And that's when accrual accounting comes. Remember that weird concept that I was telling you about? Well, basically, accrual accounting talks about the timeline of the reporting period, which means when are all of these revenues and expenses captured. And for this, you can basically follow a rule of thumb. Revenue, it's captured when it's earned, expenses when they are incurred. For finishing up this episode, I want to talk a little bit more about these two financing processes that I was telling you about. Basically, you'll have assets on one column and how you paid for them on the other column. But as you can see, this can be split in two ways, because you can either raise money by debt or you can share it by shares. And this is going to be very important for every company. Most companies, when starting, they decide to finance themselves by debt, with short-term loans or maybe lines of credit, which promise funds available for drawing credit without even using them. Companies might even have a long-term debt, but the important thing is when they start finding the other financing way, which is by shares. So when a company is giving shares, they're basically giving a little part of the ownership of their own company to someone else that's paying for that company. And all of this happens in the stock market nowadays. So when a company decides to make itself public in the market, it will acquire lots of money that will write in the common shares capital. But this is very important. What a company earns from IPO, which is initial public offering, is going to be the value that's reflected in a company's equity in the balance sheet. It's not their actual market capitalization. So, when a company sells its stocks to the public for the first time, that's going to give them an initial investment. But what happens later is that all of this is going to be in part of a market, which is called the stock market. And people are going to start buying and selling that same stock of a company, giving it sometimes more value and sometimes less value. But that fluctuation won't affect the company's financial statements. What is written is their initial public offering. And so why do you think companies might be willing to give ownership of a company? And this is mainly because financing through shares, it's going to give them the possibility of earning money without giving interests. Companies can opt to optionally give a dividend, but they don't have to do it. So they technically don't have to pay any interest for the money that they are receiving. And stocks are also attractive from the buyer side. Basically because You might receive a dividend, which would be the interest, but also because you'll have capital appreciation, which means that your stock, even if you don't do anything, throughout the years will start gaining more and more value because the company is growing and you're doing nothing about it. So basically, even though you gave your money to a company, your money will grow automatically. In the market, you'll have the market capitalization of a company, which is calculated by multiplying the stock price times the shares outstanding. But I'm going to talk a little bit more about the market, and we'll analyze the company together on my future episode. So I'll see you next week, and we'll also learn about the income statement and the cash flow statement.